Student loans are a major problem right now because we've spent the last 3.5 years making no payments on student loans, and now payments are about to begin. And people have no idea what to do. They don't know where to start. They don't know how to qualify for a mortgage because now they're going to have to make a large student loan payment that they're not used to making. Well, I have some answers for you. I have some thoughts for you. I have some considerations that you've got to make. And so listen up as I help guide you through the process of how to handle a student loan in today's new world of having to make payments again. So first and foremost, everybody's been on forbearance. You haven't had to make payments on student loans since March of 2020. So we're 3.5 years into no student loan payments. Some people were making payments and some weren't, but a lot of people actually even they graduated college and started having to make payments in the last 3.5 years and have never made a payment. So what's this mean? Well, it means you're going to get a letter if you haven't gotten one already saying, hey, congratulations, start writing us a check. And there's some new rules you need to be aware of that you really need to think about and take advantage of. And a big component of it is actually the president's SAVE plan. And the SAVE plan is his way of helping with student loans since he didn't win the student loan forgiveness fight in Congress. Now, I'm not going to be political here. I'm just going to be factual. The president is looking to help with student loans. And if you're somebody with student loans, whether you like the president or not, the fact is you're going to be benefited here. And I think it's something that you have to be proactive about. You have to grab a hold of your student loan lender and say, what are my options with the new SAVE plan that President Biden has introduced? Now, let me give you some thoughts on what that plan is. It's an income-driven repayment plan or an income-based repayment plan. What does that mean? It means the monthly payment that you make on your student loan is going to be a percentage of what your disposable income is. So they say, hey, your family size is this much, you have this many kids, and therefore it costs this much money to live. So let's say in the area that you're in, it says, hey, it costs $40,000 a year just to live. Well, if you make $40,000 a year, you have no disposable income. You have no residual or extra income to put towards a student loan. So you don't have to make any student loan payment at all. Now you'd say, wait a second, if I'm not making a payment, aren't they gonna still keep adding interest? That's one of the biggest changes. If you're eligible for this program, one of the biggest changes is they are not going to add anything more than what you're paying in interest on your income-driven repayment plan. So if your interest or your payment due is zero, then your interest charge is zero. If your interest was supposed to be $100 a month and your income-driven repayment plan says you only have to pay $40 a month. Well, in the past, in every income-based repayment plan up until now, you've had to write a check, you'd write a check for the $40 a month, and then the other 60 would get added to your balance as interest. So you still had to pay the payment. This is very much like some of the really bad mortgage programs that were available 20 years ago that got people into a lot of trouble. So now what the government has said is, no, we're cutting that off. So whatever we are charging you, that's the interest that you're paying. So if you have more income than what the requirement is to live based on your family size, then for undergraduate degrees, they're going to charge you 5% of your residual income. So 5% of the extra money that you have after paying for your living expenses. Again, it's a complicated formula. I'm just giving you a basic high level of how it works. And so if you have undergrad student loans, you're paying 5%. Post-grad, you're going to pay 10%. And if it's a combination of both, then you're going to have a sliding scale somewhere between. It's going to be a weighted average. So the bottom line is and that historically had been 10% for everybody on income-based repayment plans. So for a lot of people, the payment is literally going to get cut in half. Significant monthly payment savings. But here's where it really comes into play. It comes into play in your ability to qualify for a mortgage. And you have to be working with a mortgage professional who thoroughly understands the guidelines. Because when you do, we can put you into a program that lets me count your payment based on the income-driven repayment plan that you are on. But you have to get on the plan. And guess what? They're backlogged right now. Yeah, shocker. The student loan departments are super backlogged because everybody's asking questions. It is right, it's kicking off, payments are coming up, and they're worried about it. Now, there's a second part of this, which is great, I can get a lower monthly payment, but what about the people who can't yet get up and running on their monthly payments? How's that going to impact my ability um, to have good credit and maintain good credit, because I'm going from zero payment to now having to pay $300 a month, and I'm not used to that. And so now what they've built in is a period where they're not going to report late payments on your credit reports if you're late on your student loans. Pretty sure that was a 6-month timeline, like basically until spring of next year, that if you are late on your student loan payment, they're not going to count it against you on your credit report. The question I want to know is, are they going to count that against you on the federal government blacklist called Caivers? Caivers. That's a system that tracks people who are delinquent on federal debt. And it says if you're on the list for Caivers, you cannot take out a loan that's backed by the federal government, which means you can't take out an FHA loan or a VA loan because those are explicitly backed by the federal government. Now, you can take out a conventional Fannie Mae or Freddie Mac loan, not a problem, even if you have a hit on Caivers. And again, Caivers is what the federal government uses to track anybody who is delinquent on federal debt. So the question is, if you are having a hard time making your student loan payment, as they're transitioning into, maybe you can't reach your lender to get a hold of them in order to have them get you on an income-driven repayment plan, and you can't afford the payment that they're sending you in the bill, then they're not going to report you late on your credit report. Are they going to report you on Caivers? I don't know. More importantly, if you're applying for a mortgage during that time, I've got to take the payment that shows on the credit report. And so if that payment is not yet the income-driven repayment plan, I have to use that higher number for qualifying. So if you're thinking about buying a home, if you have student loans, you need to start now in talking with your student loan lender early so that you can get onto an income-driven repayment plan. And then hopefully we can qualify you for a Fannie Mae conventional loan, because Fannie Mae is the only program that allows me to use the payment on the income-driven repayment plan, or IDR or IBR, income-based repayment plan. Fannie's the only one. Freddie Mac, FHA, they say you have to count, I have to count 0.5% of your balance per month, unless your real payment is higher. So if you have no payment or if you have a low payment, I have to count 0.5% if you're using Freddie Mac or FHA. If you're using Fannie Mae, if I'm using Fannie Mae for you, then I get to count whatever your payment is, including zero payment if your income-based repayment plan says you don't have to pay anything per month. So it is a really critical time for you to pay attention to the letters that are coming in the mail, pay attention to what your student loan payment is going to be, and recognize this new program is very, very helpful because your balance isn't going to grow anymore. There's actually a forgiveness component at the end. I think if you pay 20 or 25 years, they will forgive whatever is remaining. Again, take a look at the rules. Google federal student loan SAVE, SAVE plan for details.